Hey everybody, Tim Albrick here, and welcome to this week's episode of the RX Money Roundup segment on the YFP podcast, where we give you our take on relevant financial news and updates, answer your questions, and break down examples of financial planning and action. Today, I'm tackling a question I get often, which is what is the best way to create and stick to a budget? But before we get into that topic, let me give a shout out to our financial planning and tax professionals at YFP that make this segment possible. At YFP, we support pharmacists at every stage of their careers to take control of their finances, reach their financial goals, and build wealth through comprehensive, fee-only financial planning and tax planning. You can learn more and book a free discovery call by visiting yourfinancialpharmacist.com. All right, this week we're talking about the best way to create and stick to a budget. And first things first, there is no one correct way to budget. So if you're listening and you're doing your thing and it's working, keep doing your thing, right? There are lots of different budgeting systems and tools, and it's about finding the one that's the right fit for you and the one that you can stay with and on track with over time. Now, generally speaking, there are three versions of budgets that are widely used, including variations of each one of these. The first is the no budget budget. The second is the 50-30-20 budget or some variation of that. And then the third is the zero-based budget. The no budget, as it sounds, is you account for your income. Let's say that's a take-home pay of $10,000 per month. You add up all of your known expenses, your fixed and essential expenses. Let's say that's $5,000 a month. And you don't overspend the difference, which in this case would be $5,000 a month. So that's the no budget budget. The 50-30-20 budget has a little bit more structure around it, where you account for a certain percentage of your take-home pay for fixed expenses. That would be 50% in this example. Another portion accounted for your discretionary expenses. That would be 30% in this example. And then another portion accounted for your debt obligations and for saving and investing. That would be 20% in this example. So you can see it has a little bit more structure than the no budget budget, but may not be to the level of specificity that some people need. And then finally, the zero-based budget, that's where we'll spend our time today, simply means that we're tracking every single dollar that we're going to earn, and we're doing it proactively before we earn the money. Now, my experience tells me that for those who are looking to get on track with their finances, the zero-based budget is the place to start, even though you likely won't stay here as things get on track. And hopefully you move to automating your system where it's working for you rather than the other way around. Okay, so as you hear this system and you're like, Tim, this is complicated, it's too structured, it's not meant to be something we're going to be working with forever, although I know some people like to do that. The reason I like the zero-based budget is it's intentional, first and foremost. It's proactive. We're spending our money on paper before we actually earn it rather than just tracking it after the fact. And perhaps most importantly is it accounts for our goals and treats them as an expense rather than hoping there's money left over. And when we can take that concept and then automate it where we fund our goals, boom, that's where things really start to happen, where we get some clarity and peace of mind knowing that this system is working for us. So with that in mind, I'm going to walk through the 5 steps of the zero-based budget. And before I do that, make sure to download our free YFP budget template by going to yourfinancialpharmacist.com/budget so you can follow along as I go through the 5 steps. Again, you can download that resource for free at yourfinancialpharmacist.com/budget. All right, step number 1 sounds obvious, but we have to determine your take-home pay. Okay, this is the amount that you'll be working with each month to cover your expenses and to put to work to achieve your financial goals. The take-home pay or net pay, it's the amount that shows up on our paycheck every pay period. We're going to aggregate this and think about this in terms of a monthly time frame. After taxes, after healthcare premiums, after retirement contributions, and any other deductions that are withdrawn from your paycheck, right? So this is what actually shows up typically via direct deposit in our bank account each month. And again, I want you to think about this on a monthly basis. Now, if you have variable compensation, I know some people listening might have commission types of jobs, or for whatever reason have variable compensation with a spouse or significant other or working part-time, right? We want to create a conservative estimate of a floor of a minimum. And then if there's additional compensation that we don't want to depend on, but that comes in, then we know where we're going to allocate it based on the system that we're employing. So that's step one, is we want to determine our take-home pay. Step two is we account for and list out all of our necessary or essential expenses. Now, the definition of necessary essential could be debated, but for the purpose of this activity and this discussion, let's include the following as essential: housing, transportation, right? Basic food, clothing, utilities, minimum debt payments, insurance payments, et cetera, right? These are the things that, even in the event of a short-term job loss or emergency, we're going to need to continue to fund. And this is relevant because when we talk about emergency funds, we're usually referencing 3 to 6 times your necessary or essential expenses. So when you go through these 5 steps and you add up all of your essential or necessary expenses in step 2, that's going to be the benchmark. That number times 3 to 6 is what we're targeting typically for an emergency fund. Of course, everyone's situation being a little bit different. So that's step 2, accounting for necessary expenses. And step 3 is determining our discretionary expenses and how much we're going to spend on those discretionary expenses. Now, think of discretionary expenses as the nice to haves, right? They're an important part of the financial plan as we strike this balance between taking care of our future selves, paying down debt, while also living a rich life today. They're important. But by definition, in a true financial emergency, or if we had to, we could cut these things. That's how we're differentiating them from essential. So examples would include eating out, right? Vacations, extra clothing expenses, extra payments that we're making on debt, etc. So these are the things that we look at and say, hey, we're making intentional decisions to spend our money on these things. They're important to us, but for the sake of the budgeting exercise, we're going to separate them out so we can see them differently than how we look at the essential expenses. Now, if you're not sure on any of these, how much you're spending, right? An important first step is to review the past 2 or 3 months. I like to do a 90-day period, pulling credit card statements, bank statements, et cetera, and categorizing those expenses. So we have a good idea of what we have been spending before we set our goals going forward. So that's step 3, determining how much to spend on discretionary. Step 4 is calculating what I'm calling here our disposable income. Now, your disposable income is determined by taking your take-home pay minus your essential expenses minus your discretionary expenses, right? This is the number. And remember, we're working proactively before we actually earn the income. So, for example, if I'm doing this for the month of December, sometime towards the end of November, middle of November, I want to be looking at this and projecting out the plan for December. So this is the number that we're going to put towards our other financial goals. So it's important we have an idea of a prioritized list of our financial goals so we can start to fund those in the order that we want to. So this could be building an emergency fund. This could be saving for kids' college. This could be for a down payment on an investment property. This could be extra towards investing or saving for retirement, right? There's a myriad of goals that we often have, and we usually don't have what we'd like to have in disposable income to match those. So we got to have a prioritized list. So just as one example, if you're, let's say you have a take-home pay $7,000 with necessary expenses of 3, discretionary expenses of 2,000, then 7 minus 3 minus 2, we'd have $2,000 left of disposable income to put towards our goals. Now, this is the really important shift because we're doing this proactively and because we're doing the hard work up front. Rather than hoping we've got that money left at the end of the month, we're going to actually direct those funds to the goals, to the buckets when we get paid, knowing that we've accounted for them and treated them as an expense. That's a beautiful thing when that happens. Really leads to feeling like you're empowered in terms of achieving your goals. So that's step 4, calculate your disposable income. Step 5 is then doing the step to allocate that income to the goals, right? That's what I was just referring to there. So once we know what the amount here is, we're then going to direct it to the goals. Now, the key here is that sometimes we look at our list of goals, sometimes we look at our amount of disposable income, and we're like, right? We have more goals and things that we want to achieve than we have the income to achieve it. So we've got options here. We can go back to step 3. That would be our discretionary expenses. See if there's anything we want to or are willing to cut. Sometimes the answer is no. Sometimes the answer is yes. Perhaps we look to say, are there opportunities to grow our income increase our income, whether that be negotiating your salary, picking up extra shifts, right? Other ways, side hustles, we can think about doing this, knowing that if we have additional income, we know exactly where we want to put it because we've got this list of goals. So this is where the rubber really meets the road. Hey, we've got this list of goals. We've got this known amount of income that we can allocate towards it. And then we've got to reconcile, prioritize, and determine what is and is not going to get funded and at what level. So again, make sure to download this budget template, yourfinancialpharmacist.com/budget. You can follow along. And then once you do that, find the system you can plug it into that will help you track along the way. Some people like to stay in a Google Sheet or Excel document. It could be a budgeting app or tool, whatever is the system that works best for you. Thank you so much for listening to this week's episode of the RX Money Roundup segment of the podcast. If you have a topic that you would like to hear us cover in the future or a question that you would like us to answer, send us an email, info@yourfinancialpharmacist.com, or you can send us a voice memo by visiting yourfinancialpharmacist.com/ask. As we wrap up, an important reminder that the content in the podcast is provided for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial product. You can learn more by visiting yourfinancialpharmacist.com/disclaimer. Thanks so much for listening. Have a great rest of your week.